And welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Shares of Royal Bank are edging higher in its most recent quarter. The lender topped income and revenue estimates, driven by strength in its capital markets and wealth management divisions. RBC also saw strong results in its personal and commercial banking segments. The lender also boosted its quarterly dividend by 6%. National Bank also beat analysts' estimates on net income and revenue in its fourth quarter. The Montreal-based lender also posted better than expected results at its capital markets unit. This is a resurgence for the division after a missed forecast in the previous quarter. The firm is set to take over Laurentian Bank's retail and small and medium businesses in a three-way transaction, including Fairstone Bank. Ivanhoe shares are up after announcing their copper production guidance for the Kamoa-Kakula complex for 2026 and 27. The mining company now expects output at the site of up to 420,000 tons next year and up to 540,000 for 2027. Mining rates there are also expected to improve gradually through 2026. And taking a look at the markets right now, the TSX back into the green after a couple of days on the offside. Right now it's up about 0.4%. Banks are mixed today as we start to see all their earnings. And south of the border, everybody back in the green. S&P 500 up by 0.36. Dow Jones almost up by 0.8. And the NASDAQ up by 0.25%. RBC and National Bank reported earnings beating expectations. But what's the bigger picture to earnings we see this week? Well, here's what Ernest Wong, head of research at Baskin Wealth Management, had to say earlier today. And overall, we've seen the results now from National, from Royal Bank, Scotiabank as well. How is it looking, the big picture to you?
Yeah, I think loan losses across the sector are a little bit higher due to the, I think in general, a weaker outlook for the Canadian economy. I think that offsetting that is obviously the strong wealth management and capital markets performance, which, I think that's really highlighting the strength of the business model that the Canadian banks have, where even if one side is weak, it is able to be offset by strength in the other portions of the business. I think on the consumer side, I think we'll probably continue to see fairly sluggish loan growth as housing prices continue to be under pressure, offset by lower rates, hopefully reducing loan loss rates going forward.
Now, despite these solid numbers for the companies, we're not seeing much movement in the markets for the banks. We're joined now by John Zechner, chair and founder of J. Zechner Associates. For more on this, John, thanks as always for joining us.
Hey, Roger. Good to talk with you.
We're seeing the numbers that people were expecting, maybe even better than what people were expecting, but we're not seeing a lot of movement. What's shaping that?
Well, that was, to me, the problem going in, and we had sort of lightened a little on the banks because I think the expectations bar was set pretty high here. I mean, the issue is the stocks are trading at basically all-time high valuations, and I mean, even on the dividend yield side, I mean, there's times in weakness in the past few years we've been buying these things at 4.5%, 5% dividend yields. Now they're all around 3%, and certainly you can find better than a 3% dividend elsewhere in the market. So they really had to hit the numbers sort of out of the park, I think, in order to justify those valuations moving forward. And so far, I mean, the numbers have been good, as you said, and as Ernest said in that earlier tape. I mean, certainly capital markets and wealth management were both strong, but where's the surprise there, Roger? I mean, we're in a bull market. I mean, capital markets activity, of course, is going to be strong. You may not get a lot of IPOs in Canada, but you've got a lot of secondary offerings from metals companies and others. So that's going to obviously help the investment banking firms, wealth management. Markets are higher, and wealth management earnings continue to grow, so that's good. And on the loan loss provision side, that was a bit of a worry, or I thought it could be a worry, because the economic data we've been seeing in Canada is certainly mixed to the, and more to the downside, especially from a portions of the economy on the real estate side and others, and what we've seen on the trade issues, and yet the loan loss provisions really did not rise. They raised a minuscule amount at RBC, but at the others, they haven't. So I mean, we've got three more banks coming tomorrow, but typically 40 basis points, which is where the loan loss provisions are running right now. That's typical economic strength times. It's when you get into recessions, you see these things sort of move to 60 or 70 basis points, and so that'll be the big question going forward is where do the economy goes. But these things are priced, I wouldn't say for perfection, but they're priced for very good numbers. They got very good numbers. I think if I were to pick out the one that really did exceptionally well, and that is showing in the market, it was Royal, because they not only beat on the capital markets, they increased the dividend, they increased what their longer term ROE, rate of return on equity target is to 17%. And on the cost side, they brought them down substantially, which is key for the banks, because you're running out of areas how you can keep bank growth going for the Canadian banks. And one way is obviously on the cost cutting side.
And can we expect similar numbers for the banks that are reporting tomorrow? And
yeah, you know what?
I know it's a big crystal ball on that, but I mean, so goes one, pretty much goes the others.
Well, you're right, Roger, but there is a difference in the banks that are reporting tomorrow, because the ones that came out today and even yesterday, particularly, they still have acquisitions they can bring, they can help growth. I mean, look at RBC's growth. A lot of it is still because they're bringing in the HSBC Canada. You're getting the synergies from that. That's helping your growth, and obviously National Bank is benefiting from the Canadian Western Bank acquisition, and now they're going to get chunks of the old Laurentian Bank as well. So that'll keep them going. On the other side, I'm looking at TD, Commerce, Bank of Montreal reporting tomorrow. They don't have those same kind of additives in there. I mean, and going forward, that's a bit of the risk. I mean, where does the growth come from? I mean, the U.S. had been a source for a while, but I started to look at the recent activity that Canadian banks have done in the U.S., and it's not been very good. We saw TD Bank failed to get Horizon, maybe for because of the money laundering issue. Royal Bank was still sort of choking a little on the City National acquisition a couple of years back. Bank of Montreal had a number of bad quarters when they tried to swallow Bank of the West. So, if that's where your acquisition opportunities are, that's a bit of a problem, because you're not seeing, a good ability to do these acquisitions and make them accretive and get through some of the regulatory issues as well. And we all know the relations between Canada and the U.S. have not been improving lately, which is another headwind there. So how do you grow? Do you grow you have to grow in Canada, and there's no more smaller banks to pick up. So that's a bigger question going forward. The growth has to be on the electronic side. And, how do they do that? What do they pick up? Do they start to buy some of these new, the newer firms that are doing more electronic banking? Do you go after Wealth Simple and companies like that? I mean, that was the Canadian strategy in the past when, back in the 80s, when they started losing out on capital markets activities, they went out and bought all the brokers. And then the same thing on the money management side, when they started not, competing as well, they went out and bought, the big money management firms as well. So, will they turn around and just do some acquisitions or try to grow it organically? I think that's the headwind for the Canadian banks right now. Valuations are high, and there's very few growth opportunities that I see, and that's why we're looking elsewhere. That's why I'm underweight the banks right now.
Okay, we're going to leave it on that note there. That was going to be my last question. What are you doing with them? You're underweight. John, always a pleasure, sir. Thank you for joining us.
Thanks, Roger.
John Zechner is chair and founder of J. Zechner Associates. Up next, home sales are down once again in two of Canada's largest cities. We'll talk about those numbers right after the break. Home sales are down once again in two of Canada's largest cities. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. And Lindsay, thanks as always for joining us. Yeah, the numbers are pretty grim, aren't they?
The numbers are pretty grim for both cities. We'll start with Toronto, though, because those numbers came out more recently, and it's also the largest real estate market in the country. New home sales are down. Home sales in general are down. Activity is down, and listings are down for Toronto. Yeah, so all trending downwards for the month of November. And so when we talk about home sales, we'll start there. 5,010 homes were sold last month in the city of Toronto. That's actually down more than 15% compared to the same month last year, November of 2024. And when we look at month to month, that's a drop of 0.6%. Now, according to TREB, the Toronto Real Estate Board Association, it's mostly because a lot of people are kind of concerned about their jobs, actually. They're concerned about the economy. Yeah, they're concerned about, the current trade war we're in, not sure whether they're going to have long-term employment. And because of that, they're either holding off on taking out, like a larger mortgage, or just holding off on getting into the buying situation as a whole. And so they're staying on the sidelines longer than what some have predicted they would. When it comes to listings, just over 11,000 new listings in the month of November. That's down 4% from last year. And for Toronto, the benchmark price of a residential composite home is just over $951,000. So that actually has come down.
It's come down. Still a decent chunk of change, though.
Yeah, it is. It is. Yeah, for a lot of families in Toronto.
And Vancouver, similar situation unfolding.
Yeah, especially when we're talking about home sales in Vancouver, a very similar situation. Apparently, the city is actually on track for its lowest year of home sales this century. So that's pretty phenomenal to see. Home sales down more than 15% in the month of November, so same percentage actually as Toronto. And that's apparently at 20% below the seasonal average. Month over month, it was more stable, just dropping by 0.1%. But apparently, it's the same situation here. Like, buyers obviously have ample choice if they did want to get into the housing market. Prices are pretty good, obviously lower borrowing costs as well. So that's kind of forcing sellers to negotiate a bit more. We see that, like, a lot of people are taking down the price of their homes, whether that's for rent or to buy. But at the same time, people in Vancouver also feeling that hesitancy when it comes to the job market. Will they have a job long term? And what does the economy look like long term for Canada? So a lot of people just sitting on the sidelines there. And a benchmark price for a home in Vancouver has come down. The benchmark price now is $1.12 million.
Whew. Holy cow.
Yeah.
Okay, so any good news?
Yes, there is some good news, because I know this
I guess it's relative. If you're a buyer right now.
Well, it is relative. It's subjective to who you are and what you're looking for. If you're a buyer that you have a very steady job and a steady income, then maybe this is great news for you. For the majority of people, though, they're concerned. But there is good news. Looking into 2026, we were speaking with Jason Mercer today from the Toronto Real Estate Board. He says we are poised for a recovery across the country in 2026. Here's more on what he had to say.
If you think about, the income that would have been required to purchase the average price home in the GTA at sort of the top of the interest rate tightening cycle, that was over $200,000, which is well above the average household income in the GTA. And we've seen that come off probably by about, $65,000 to $70,000. And so that really speaks to the improvement in affordability. And I think a lot of households realize that, and they have every intention on purchasing a home. They just need to see a little bit more certainty around our economic future in the GTA and Canada-wide.
So that's for 2026, though, that there could be kind of a recovery there. For the last month of 2025, it looks as though it's going to be slow. Obviously, December is one of the slowest months of the year when it comes to the housing market.
Okay, Lindsay, thank you for that.
Thanks.
BNN Bloomberg's Lindsay Biscaya. Still ahead, new forecasts show Canada is expected to build only 26,000 homes over the next 5 years. But according to Canada's Parliamentary Budget Office, federal spending on housing is expected to decline by more than half over the next 3 years if current programs are not renewed. We'll hear from Jason Jacques, the interim parliamentary budget officer, after this. Federal spending on housing is expected to decline by more than half over the next 3 years if current programs are not renewed. This, according to Canada's Parliamentary Budget Office. Within its current spending plan, the PBO says Build Canada Homes will add only 26,000 homes in the next 5 years. Now, in August, the PBO said Canada would need to build about 700,000 by 2035 to restore housing affordability. Now, earlier, we got insight into the numbers with Jason Jacques, the interim parliamentary budget officer.
On our end, we're working with the data, the public data published by the government as part of their short-term planning, their longer-term planning. And of course, we're looking as well at information that was shared with us by the Department of Finance around Budget 2025, which shows about a 56% decline in federal spending on housing. There might be subsequent decisions made over the next 3 years. But I think as most people realize, if the public numbers are forecasting some sort of decline, there could be an offset, but you got to go with what you see right now.
So I'm curious, how do you circle the square here between what seems to be an oversupply based on pricing that was, most likely outdated, and a shortage of new homes that really, where I guess the public at large really needs more affordability. How do you bring those two forces together from here? Because it seems like we do have a bit of a mismatch. In terms of
oh, sorry. Go ahead.
No, just
no, I was going to say
yep.
it's a really good question, and I think there are two things going on. And the first one, I think you hit the nail on the head in terms of the homes that, for people who are actually looking to get into their first home, the homes that they're looking to buy, the supply of those homes on the market, there isn't necessarily the supply of those homes in the market. So within various markets across the country, the people that are looking to move from renting into buying their first home, or just looking for a rental to rent something, there isn't the supply there that they would necessarily need and look for. The other thing to keep in mind is there are effectively 16 distinct regions or housing regions across the country. So while Toronto obviously has a really big weight alongside Vancouver and the other major metropolitan areas, there are 16 distinct regions. So even if there is an oversupply in the case of Toronto, not everybody's going to move to Toronto, and obviously you can't take the housing supply from Toronto and shift it out to Montreal.
So do you think at the end of the day, the federal government's going to make money on this program? Is the goal here to stay neutral, or is this basically like a subsidy just to help the average Canadian out?
I think in terms of most government programming, obviously it's the public sector. So the government is not getting into it to make money. That's why we have the private sector, and that's why we have capitalism. That said, there is a good part, especially on the Build Canada Homes side, a big part of the funding, which is offering loan guarantees and concessionary loans, which could provide some sort of revenue back to the federal government, potentially to sustain the program and sustain the organization. But obviously, with most government programs, one would expect that there's going to need to be some sort of ongoing federal support to keep these programs in place.
And you mentioned about getting the private sector involved. It's with everything that's unfolding within the housing market right now, there doesn't seem to be an appetite. How do you convince them that to get involved and it's worth it to them?
Well, obviously, we're not experts in that specific area. We did look in detail at what the government's doing around Build Canada Homes, and I think looking at the structure of the new organization, it is pretty instructive, because it isn't simply a question of the federal government cutting a check to somebody and kind of hoping for the best. It is more of a comprehensive approach where you do have a suite of financial supports that are offered to private sector developers. In addition to that, focusing on the federal assets themselves and looking at opportunities for conversion. And last but not least, something that Build Canada Homes itself isn't looking at, but the government has indicated within the housing sector it's looking at, is on the regulatory side. So both if things can be simplified at the federal level, and in addition to that, especially as part of the Housing Accelerator program, leaning on municipalities across the country to try to streamline regulation to make sure that, the regulatory burden on developers or on the private sector, when they want to go in and build something, it's a lot lower. So that both saves time, which is money, it also saves money, and it also provides certainty, right? So if you're looking at a 24, 48-month cycle where you need to go obtain the financing, get the land in place, line up the potential buyers, and start to make those investments, there's additional certainty in place, so the math in the spreadsheets works out.
So if you're at the helm and you're able to influence 100% of policy here, what would your projection be in 5 years? Where would we be at with this program in terms of new housing?
So on our end, within the Parliamentary Budget Office, we don't do policy. We only do numbers.
Sure.
So effectively, we're the referees. So we're the folks that are supposed to look at look at the numbers and look at the spreadsheets presented by the government around their policy plans and say, okay, in reality, this is what cold, impartial analysis would tell you, as opposed to the thousands of comms people who work in government are going to tell you with the glossy brochures and the nice websites. The numbers that we're looking at this point, based upon the historical track record of the government, indicate that there's probably going to be about 26,000 units created over the next 5 years in Build Canada Homes. The government has a higher number, and I think from the government side, their argument is what they're trying to do with Build Canada Homes is, I think they've used the word transformative. Certainly from our perspective, it very well might be transformative. What we look at is what's the government's track record? Similar to, I guess, what your audience is familiar with. If there's a company, publicly traded company that's out there, they have a track record, you know what the return on equity is, you know how effectively they can execute on plans. If that company comes out with a press release and says, you know what, don't pay attention to what we've done in the past, focus on the transformative element of what we're doing in the future, for which we don't necessarily have a track record, potentially it's something you might want to pay attention to. Potentially the numbers might be a lot higher than the 26,000 we've come up with at this point. And at the same time, there's the weight of history that the government obviously has to deal with. And again, 26,000, it's not nothing. So we've, as you mentioned at the outset, we've indicated the government, there's a gap of about 65,000 homes and builds that need to happen every single year for the next 10 years to restore affordability. So if we're looking at an additional 5,000 a year over the next 5 years, it's definitely a step in the right direction.
And that was Jason Jacques, interim parliamentary budget officer at the Office of the Parliamentary Budget Officer. After the break, we'll bring you our conversation with the CEO of Flair Airlines, and we'll discuss the company's latest changes. That's next. Federal spending on housing is projected to drop by more than a half over the next 3 years, according to the Parliamentary Budget Officer. Ottawa spending on housing is set to decline to $4 billion in 28-29, down from $9 billion in the current fiscal year. The decline is a result of various housing programs that will expire. PBO notes, though, that government's departments could decide to extend them. Tamarack Valley Energy shares are trading higher after the company laid out its corporate plan for next year, focusing on steady growth in its core oil plays. Tamarack says the $300 to $400 million budget will support continued development while keeping costs low. Tamarack is also promising more money to shareholders through buybacks, dividends, and ongoing debt reduction. The board is also adding a new director as part of its longer-term strategy. Shares of TELUS are moving higher. The telecom plans to pause its dividend growth while continuing to pay its quarterly dividend at the most recent level. TELUS says the pause will remain until its share price reflects growth prospects. The Vancouver-based company also announced a new 3-year free cash flow growth target of 10%. And taking a look at the markets right now, you can see the TSX back up in the green. Pretty much 7 of the 11 are up right now, the groups. And leading the way, Tamarack is the one we were just talking about. You can see it's up 6.5%. Capstone Copper, record copper prices right now we're looking at, and that's driving Capstone Copper up nearly 7%. And International Petroleum in a similar situation, up nearly 7%. And south of the border in the U.S. markets, it's a mostly green day right now. After starting off a little slow, it's picked up. S&P 500 up by 0.34%. Dow Jones by nearly 0.8%. There you go, that's 2.8%. NASDAQ, it is up by about 2.2%. Flair Airlines has seen some controversy surrounding its service reliability and lack of amenities, to name a few things, but the CEO has announced some new changes. We were joined earlier by Maciek Wilk, the CEO of Flair, and we kick things off with an overview of the workforce and the current fleet.
20 aircraft, all modern Boeing 737 Maxes, about 5 million passengers, flying mostly Canadian domestic, but in winter also a lot of Caribbean, Mexican, and U.S. destinations.
Right. And how many Canadian cities are you flying out? What Canadian cities are you flying out of right now?
Well, all of them, but no, and I mean all major ones. Okay. We have 4 key bases, which is Vancouver, Calgary, Edmonton, and then Toronto. But we cover also like a number of other Canadian destinations. But as I said, also connections down south, like opened only recently, flights to Mexico City from Vancouver and Toronto.
You have acknowledged that there's been service problems, lack of amenities, but you say that Flair is pulling up its socks and things are different. I know you don't want to dwell on the past problems, but what caused those?
Well, I mean, it's been a long and bumpy road, but I can honestly say that by right now we are a different company than some of the passengers might recall from the past. I'm proud to say that we are the most reliable airline in Canada in terms of on-time performance and completion factor. And this is not only me saying this. This is data coming from reliable independent sources. This is a true change that we've introduced to the company. Haven't always been like this, but certainly right now we are proud to be this most reliable carrier in Canada.
Okay, I hadn't seen that data myself. So tell us, who owns the airline now? Can you just describe who are the basic owners?
Well, this is the rather wide portfolio of Canadian and U.S. investors. Overall, Canadian investors hold about 65% of all ownership, and American investors 35%. There's been some shareholder changes this year. I'm happy to talk more about it. But right now, this is how it looks. There is no single majority owner of the airline.
Right. Now, you are doing one thing, and you just announced this. You're saying that if you pay for a carry-on bag, you can skip the line and board with ease. We all hate hanging around at the gate. Just tell us quickly how that works. It sounds attractive.
Yes, and this is a perfect timing because we're launching this just today. So the new product is called Flair Express, and it indeed allows you for a smooth and frictionless experience in the airport from the check-in till the boarding. You get priority boarding, but most importantly, you have the opportunity to skip what's creating most friction, which is sizing your bag in the metal sizer. We recognize that this is a point of friction, but actually our ambition as a company is to become the easiest airline to fly, not only financially, but also physically and emotionally. And we recognize that this is a true point of friction. So should a passenger purchase a carry-on baggage from now on, from today, there's this Flair Express product which allows them to enjoy a very smooth, uninterrupted travel.
So, in other words, sorry, I know we can't get into all the deep, but if you decide I'm going to check the bag, I'm not going to carry it onto the aircraft, you get this priority boarding.
No, if you have a carry-on, so if you have your little suitcase together with you, nobody will bother you anymore at the gate, unless you want to bring a tuba into the aircraft, which will be a problem, obviously.
Oh, I see. Okay, but you have to pay for a carry-on bag.
Yes.
Okay,
yes. This is one of the fundamentals of the business model. So indeed, but 40% of our passengers select not to fly with any carry-on, and we also need to have a product for them.
Just finally, I know you had an interesting interview at the Toronto Star, and you said that you've decided, or the company, you're not trying to emulate the European ultra low-cost carriers such as Ryanair. Just tell us briefly how your model is different.
Well, this is the major realization that we had over the last couple of years, that simply copying and pasting European ULCC model like Ryanair or Wizz Air hasn't worked in Canada and will not work in Canada, out of various reasons, starting with demography and geography of the country. We recognize the fact that Canada is an enormous country in terms of its size, while populated by only 40 million passengers, and this creates all kinds of challenges. That requires a low-cost airlines like ourselves to really become a value airline. and create a product that is tailor-made for this very unique market.
And he was speaking with Maciek Wilk, CEO of Flair Airlines. Coastal First Nations chiefs voted against the new pipeline to BC. The implementation of a new pipeline, they say, increases the risk of oil spills that could significantly affect the livelihood of the people and the wildlife in the region. Mark Carney, the Prime Minister, has committed to a First Ministers meeting with First Nations to face growing concerns about the pipeline agreement. CTV's Abigail Beeman has more.
Do you respect the direction of the rights and title holders?
BC's regional chief among those with a rare chance to question the Prime Minister, as coastal chiefs are staunchly opposed to the new MOU between Ottawa and Alberta that sets the stage for a new pipeline.
I look forward to that meeting at the earliest opportunity.
Mark Carney says he will meet with the coastal BC chiefs and committed to a First Ministers meeting with First Nations early in the new year.
Under the leadership of the Minister of Indigenous Services, this government intends to introduce water legislation in the spring of 2026.
Key on the day one agenda, an emergency resolution to maintain the oil tanker ban and a call to scrap the new MOU.
This resolution has been accepted.
It passed unanimously.
First Nations in Canada are feeling overwhelmed, that they're feeling as though the duty to consult is being undermined.
Merle Alexander is representing 2 BC coastal First Nations.
There also is a real pushback against this regression on environmental and climate change policies.
Canada can create all the MOUs, project offices, advisory groups that they want, but chiefs are united. When it comes to approving large national projects on First Nations lands, there will not be getting around rights holders.
It's bad enough First Nations don't trust the government, and this makes it even worse.
The message about a need for more consultation coming not just from BC, but chiefs across the country.
We've had enough of being excluded, and there's going to be trillions of dollars going to be extracted over the next 10 to 100 years, and for First Nations to get chump change, it's not going to happen.
The Special Chiefs Assembly continues here until Thursday. Also on the agenda, a plenary session about the Major Projects Office and Indigenous Advisory Committee. Abigail Beeman, CTV News, Ottawa.
Well, this morning, Royal Bank posted a 29% jump in its fourth quarter profit, hiked its dividend. We'll bring you a reaction to those numbers after the break. Royal Bank posted a 29% jump in fourth quarter profit and hiked its dividend. National Bank says its fourth quarter rose on strong wealth management. For more on these Canadian bank earnings, we were joined earlier by Tony Sierro, President and CIO of Caldwell Asset Management, a division of Caldwell Securities.
We were expecting that, particularly the capital markets and wealth management, where we've seen the most growth. The other sectors, the personal banking side and loan growth, we can see that a little bit under pressure going forward. The personal banking, as banking fees come under scrutiny a little bit more, and loan growth, direct reflection of the Canadian economy. You mentioned earlier that the housing prices and costs are coming down, so loan growth will be stagnant and potentially the provision for credit losses will increase. But the capital markets and wealth management, that's the area going forward. And if you can hone in on that, you definitely have potential good growth going forward.
Sorry, Tony, I cut you off there. You refer to fees. Do you think, I mean, the budget, as you know, referred to the government's desire to improve competition in banking. Do you think the banks will be under scrutiny over the fees they charge?
I believe so. You're seeing on the investment side, fees being more transparent. So I believe something will be done on the personal banking side. And not to get into details or as far as we know, but if you see a creation of a stable coin currency that's backed by the Canadian dollar, stablecoin will make everyday banking more efficient, wiring transactions at zero cost. So things like that could put pressure on personal banking side.
The banks will resist that. People doing anything at zero cost.
Exactly. One thing I do want to mention, on the dividend yield, they increased by 6%, and that's the quarterly dividend payout. And if you factor yesterday's price, the new yield will be about 3%. So that dividend hike of about 6% on the quarterly dividend will lead to about a 3% dividend yield. And that brings it back to within the minimum standard. If you're looking at some investors living on the dividend yield, 3% is acceptable. So that's quite positive as well for the bank. So I'm glad we saw a dividend increase of bring it back around 3% overall.
That's interesting, but it's not really much of a yield, is it, compared with some of the pipeline stocks? Or you can do better even with a name like Canadian Natural Resources. It's not that generous, 3%.
Exactly. And again, I've only secluded the investors looking at investing for dividend yield. Overall, though, you have to take the company Royal Bank in itself and its growth outlook going forward as part of the equation if you're making an investment decision. But vis-a-vis the National Bank, which increased its quarterly dividend by only 5%, we anticipated a 6% increase there as well. And that 5% dividend increase only means it still will be below 3% on the dividend yield on the stock. And that might not hit the criteria that some investors are looking for from a yield. So National Bank came out with very strong earnings this morning as well. Capital markets was an area, so was wealth management. So trending in the right direction. And earlier this year, the acquisition of Canadian Western Bank, you can see that acquisition filtering down to the bottom line as well. However, though, the dividend yield was a little bit of a disappointment. We anticipated a 6% increase. I'm not sure that will affect the stock performance today. I think it'll do well as Royal Bank, but a little bit disappointed that the yield wasn't increased a bit higher.
So you'd be inclined with new money to buy Royal Bank, but National Bank is a hold for you right now?
Yes, and there's a couple of reasons for that. Royal Bank, we like the acquisition of HSBC Canada it did last year. Now, even though HSBC is a bank in Canada, it has the global capabilities. So Royal Bank, the explicit revenues, you see them right away, so reduced costs, bringing on more revenue streams by the acquisition. But the implicit revenues that you can't see are what we anticipate going forward. That intellectual property you got from a global wealth manager will reflect down to the bottom line of Royal Bank as it enhances its scope, more of a global investing bank versus just a domestic bank. So we think those implicit reasons, intellectual property acquired vis-a-vis HSBC Bank Canada will do well going forward. Also, Royal Bank raised their profit forecast for next year, the profit targets for next year, and that's quite good to see. Royal Bank is the Canada Bank. It's the People's Bank in Canada. Our economy seems to be in a little bit of a rut, but however, Royal Bank continues to raise their target, which is pretty positive.
Give us your take, finally, Tony, if you would, on gold. What kind of a weighting are you holding in your portfolios in bullion?
On the high end, it's 5%, and the more conservative end, it's about 2%. And the reason why we're doing that, it's a direct hedge if you continue to see a weakening of the the U.S. dollar. There's all kinds of political pressure on the U.S. dollar to weaken it. You want to improve your exports and you want to buy more domestic, so you weaken your currency to do so. And gold, because it is valued in U.S. dollars, if the U.S. dollar becomes weaker, the price of gold will need to appreciate. It also is not always, but historically there has been times when you saw market volatility and the price of gold stabilize or increase. So for us, it's a way to mitigate some portfolio risk, but also to mitigate some of the political pressure of declining U.S. dollar.
And he was speaking with Tony Sierro, President and CIO of Caldwell Asset Management. Still ahead, TELUS says it's putting future dividend increases on hold, responding to pressure from investors about its debt. Bloomberg's Derek DeClue will tell us more after the break. Know Your Options is back. Tune in today at 3 p.m. Eastern to have all your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowYourOptions@bnnbloomberg.ca. Well, shares of TELUS have tumbled 19% over the past 3 months. Its dividend yield has shot up to more than 9% as analysts questioned its lack of growth and its investment strategy. And now TELUS says it's putting future dividend increases on hold. For more on this, we're joined by Bloomberg's Derek DeCluid. He is the executive editor for Canada. Derek, thanks very much for joining us.
Thank you.
What has investors worried? What has everyone worried, it seems like, right now?
Well, part of the story in the telecom sector is growth. And we saw this earlier in the year with BCE, where it ultimately decided to cut its dividend because of pressure on its balance sheet, debt that it was going to incur or had incurred, and the acquisition of Ziply. And all of that made BCE's dividend too high. Now, sort of for different reasons, similar pressures have come to TELUS. What's happened in the sector? The wireless market is very, very slow growing now because of price pressure, increased competition, and less population growth because immigration has slowed down. And then you layer on top of that, you have more competition in the broadband sector, in the home internet sector, and in television because of regulatory reasons, and that decision by the regulators and the government back in the summer to allow more broadband use on other networks. So you have a slow-growing sector. You have sort of a uncomfortably high debt at TELUS, about 3.5 times EBITDA or so, and it all sort of adds up to concern about how sustainable is that TELUS dividend, and so that's why they've acted today.
And they said they want to get it down to 3.3 by the end of September. Does that seem realistic? What are people saying?
Yeah, I mean, analysts seem to like this plan to sort of trim away the debt. The key thing here is that TELUS has walked back the idea that they're going to just keep growing the dividend year after year. Unlike BCE, they opted not to cut it today, but they're essentially going to freeze it for an undetermined period of time, and they're quite rightly, I think, being not specific about how long they're going to keep it frozen. But that allows the underlying cash flow of the company to grow, and TELUS also did give us somewhat bullish forecast on how free cash flow at the company can grow over the next few years. Allows them to trim that debt and give people more confidence about the future of the dividend. So for somewhat similar reasons to BCE, but it's taking a different approach here and saying we're going to deal with this with the balance sheet issues over time by simply not increasing the payout further.
And I don't want to put you out. I saw a story. TELUS is looking for a strategic partner to invest in TELUS Health. Is there any details on that? Have you heard any details about that?
Yeah, I mean, this is, I guess, part of a broader strategy for TELUS to find other avenues of capital in some of its divisions. We also saw them make a move earlier this year on wireless towers, where they sold a chunk of that as a separate business. Pension fund money is very interested in that sort of thing, and TELUS Health, is something that they have incubated and grown over time into a significant business. And now it's time for them to sort of let it out into the world and see if they can find some capital to help it grow further. And also, of course, that if they can do that successfully, that too will be something they can an effort they can make to clean up their balance sheet a little bit and pare away at the parent company's debt.
Okay, we're going to leave it there. Derek, thanks as always for joining us. Bloomberg's Derek DeCluid. And that wraps up this edition of Trading Day. Have yourself a great afternoon. We'll be back here tomorrow.